Today, folks, do you feel as much of like an idiot as I do, missing the Nvidia insanity? I mean, Nvidia alone accounts for more than a third of the S&P 500's gains this year, and you've probably seen the headlines like, if you just invested $1,000 in Nvidia 10 years ago, today you'd be worth $1 million. Sucks to be you, because nobody can look retrospectively in the past and project that shit into the damn future. I mean, it is impossible. But when you look at Nvidia, it's like year to date, 181% gain. A lot of people starting to chase here, and you don't know if you're catching the tops, the bottoms, the right in between. Where do I sell? Well, that's the reality of why I think at scale, when investors really start to get to a larger positioning within their portfolio, they always start leaning more toward ETFs. It's something I've done. It's something I've seen a lot of investors do in the community, because these passively weighted systems remove and alleviate so much of that stress of the quarterly reports and the news. And is the Elon getting his pay package, or is he leaving the company? I mean, these are things that really stress people. That's why investors look so damn old for the most part, maybe with the exception of Berkshire's Warren Buffett or something like that. But taking a look at the S&P, for example, that's up 16% this year, which is an absolutely jaw-dropping return. Yes, it's not 181%, but the likelihood of you leveraging your whole portfolio on Nvidia is sparse, because if it drops dramatically at any point in the next year, you need to figure out when to sell. But the S&P doesn't really care if Nvidia drops that much. Yeah, it's accounted for a lot of this return, but the fact is it's market cap weighted ETF. So if Nvidia loses 50% of its value, as it's losing that value, it's going to drop below these market cap weighted values, and it's going to start impacting the overall S&P 500 less and less as it loses value. And as it gains value, it'll equal to more return within this portfolio. This is why passively weighted ETFs are just juicy. They're just brilliant. And what I find most impressive is I don't think people appreciate the prolific scale of the top 5 holdings in this ETF. I mean, if you look at JP Morgan, Eli Lilly, and Berkshire, these 3 lower half companies are worth between $500 billion and $876 billion, which is already insane enough. But when you jump to the next company on the list, being Google, you get into a whopping $2.1 trillion market cap, and obviously the upper weightings are in the $3 trillion. Google already twofolds the bottom 3 companies on the S&P top 10. I love having exposure to these, and I love knowing that I can cost average in, alleviating, am I buying the tops, am I buying the bottoms, how do I time this? Because a lot of people try and do that with the S&P, which is just dumb, because if you zoom out on over 5 years, even if you bought the top of 2021, you're up 15%. If you just cost averaged all the way down, the bottom shares would be up 53%. And you never know where that top is, because it's been a topping top for a very long damn time. But ETFs go so far beyond this for other investors, right? Like if you're purely growth oriented and you want that tech exposure a lot more concentrated, which I think is probably a prudent thing to do. I mean, the Nasdaq's up 21% in not even 6 months, guys. We're not even 6 months into the year, and it's really just concentrating a lot of those upper weighted tech companies, right? If you want more global market, you want a little bit more diversity in risk adjusted returns, you look at something like VTI, the total stock market index, right, which is only up 14%, lagging the S&P by a few percentage points, but that's because you're getting some lower market cap weighted, small cap oriented companies, right? But again, mostly weighted in them big tech companies, just not as concentrated. Or if you're really conservative, you can look at cash ETFs, which are some of my favorites right now, because in the higher interest rate environment, these things have been just pooping out beautiful gems of divvies with absolutely no volatility. As of today, the trailing 12 month was 5%. Obviously, the annualized yield right now is about 4.79%. That's paid monthly, by the way, with absolutely zero volatility, because there's a manager out there that said, hey, I'm going to go find the best deals, the best promotions on the highest interest savings accounts that Canada has to offer. And then they went out and made an ETF, so that you get they just take your cash and put it in high interest savings. It's a brilliant thing. And a lot of investors will also be leaning into dividend oriented ETFs, which become very unfavorable. And it also is a very challenging topic, because a lot of the companies in these dividend ETFs are highly affected by the interest rate. So whereas the cash ETF benefits, it isn't going to benefit when interest rates drop, whereas these dividend-oriented ETFs will likely benefit greatly, because that means a lot of the debt that a lot of these infrastructure-oriented companies that you find in these ETFs start not having to pay as much on those heavy debts that they have on the infrastructure. And we're talking about like oil and energy companies to things like Home Depot and Pepsi and Procter and Gamble. Like a lot of these companies are largely affected by the swings in interest rates, right? So we're not seeing any real great performance out of these this year. I mean, you could say the same thing about VDY with your Enbridges of the world. And I mean, there's so many companies like the banks in here that have been very volatile, but it removes a lot of that volatility, because a lot of these stocks like 3M that a lot of dividend investors were chasing, I mean, this thing has lost an incredible amount of value from the top, down 41% during still one of the greatest growth periods we've seen in the S&P and tech companies alike. Starbucks, another prime example of a company that hasn't really done much for investors over the last 5 years. And if you were picking these and concentrating them in your portfolio, you've missed out on so damn much of your return. That's why I've kind of leaned into a strategy as of lately of looking at not only ETFs, but individual stocks that I can pick and correlate in a way where they balance each other out, right? And I've looked at these kind of really intriguing ETFs like the low volatility Canadian equity ETF that has actually outperformed a lot of the broader markets from the dividend side of things, but it actually picks really favorable stocks based on metrics that have to do with obviously how much volatility, what's the dividend payouts, how reliable are the dividends, are they increasing? And these are kind of like mutual funds almost. They remove a lot of the risk, and they've done an exceptional job at offering really stable returns for people. And you can look at these, and I think it's really prudent as an investor to figure out what your risk tolerance is. Pick a variety of these, educate yourself on them. Don't just leave it up to a financial advisor. You need to educate yourself and understand your money, because you're the only one that's going to care the most about your money, and literally spread it out and pick the pots that work the best for you. And for me, as many of you know, I've done it between the dividend ETFs, the growth things like the S&P 500, and individual tech stocks like Tesla. But I like limiting my individual stocks so I can understand them and focus on them more clearly. I truly believe if you start picking 20, 30, 40 stocks, you are no longer understanding your portfolio and where it's going, and an ETF would do you much, it'd serve you much better as a fiduciary than you are to yourself. And I'll pass that question off to you. I'd love to know what your favorite ETFs are in that comment section below.